Hello YouTube, hope everyone is doing well. I know it's been a while since we last spoke about step index. Our last commentary was on the September 20th. I was talking about a reversal profile that tends to happen on step index around that time. Well, since then I've been quiet. I've been observing the markets. It's been a back and forth type of market condition. And this is the market condition that I don't like to trade. But I have some tools to help you navigate this type of price action. Now, I have taught in my September's commentary how to pursue a market that is in consolidation. I spoke about it, I taught it in September's commentary. If you are dealing with a consolidation market, then what is the PD array that is most suitable for that market condition? It would be an order block. Order blocks in consolidation markets, they work wonderful. But if you were to use an inefficiency in a consolidation market, you would be more times wrong than right. Okay, so a PD array has to be used at a suitable market condition. Okay, you match the market phases with the PD arrays that are best suited for that market condition. So in a consolidation market, you can clearly see how we used this bearish order block of the 28th of September. We used it here and we used it here. We tapped into it one more time. All right, so this is a PD array. It is the highest up candlestick taking out this high here, which was the target for September when we were going counter trend, going bullish, going against the trend. You can clearly see how it was in a bearish market condition, but as we arrived in the 20th, it then started to go to the upside and reverse on the trend that has been for September. So it is a tendency, good people. It tends to happen more times than not. All right. So this was the October 20th price action. It goes against what the trend has been. And we usually have these types of characteristics. It moves with speed. It is in a rush. Okay, it doesn't have a lot of time. It is in a rush to get to somewhere. So what type of PD array would be suitable for a market that is in a rush, meaning trending? Okay, if a market is trending to the upside really fast around the 20th, then we ascribe a fair value gap as a suitable PD array to participate inside of the market, or it is simply beautiful to just observe it. Okay, you don't have to trade it. If you're not familiar with market conditions that move with speed, if you're not suitable for that market condition, then stay out of it, just observe it. But over time, you're going to see that this is a recurring phenomenon that around the 20th price action tends to reverse. Okay, so we ascribe a reversal profile around the 20th, especially if the conditions are there. So we have a consolidation market. We are moving from a support. We just took out this sell-side liquidity, and it's around the 20th. We expect the market to attempt to get to the resistance. Okay, so it is a recurring phenomenon. All right, you can just go opposite around the 20th. I've done it in the 20th, or observed the 20th reversal for October. I normally give you guys like a signal as to this is what's going to happen, and the market does it. But in here, we have a lecture going on, good people. We have a lot to talk about in the consolidation market. Okay, so in the consolidation market, number one, you don't have to trade every time. The market goes back and forth. All right, so In a market that goes back and forth, you lower the trade frequency. Your probabilities go lower in a market condition like this. Okay, your winning trades are going to be less and your losers are going to be more. So what can you do with that? You can just lower your risk. Okay, simple as that. In the consolidation market, lower your risk because you're going to take more trading opportunities than ever. Yes, a consolidation market is best suited for scalpers. If you're used to holding trades up to the closing day, we meaning that you are a day trader, then this market condition is not going to be good for you because sometimes the market tends to go back and forth. All right, you might be in a winning trade in the morning, and then by the New York session, you're in losses, stopped out. So we avoid overtrading. Okay, but that's not the main lesson for this type of market condition. So today we are going to be talking about the weekend price action. In September's price action, I touched a little bit about the weekend price action. In this video, I'm going to be giving you a deep study of the weekend price action. Okay. So since we were at a support, we took out the sell-side liquidity pool. We did a market structure shift here. You can clearly see how price was moving aggressively to the upside. Okay, it was aggressive going into the upside as opposed to this type of consolidation. So what is the market doing? It's grabbing the sell-side liquidity and reversing. So it is around the 20th price action. These are the type of conditions that I expect. I expect that price action is going to move with speed. It's not going to consolidate. So here is a market structure shift. Here is an inefficiency of that particular week. So this is the 18th, right? It is a Saturday. On the 19th, we start a new trading week. It is Sunday. So Sunday, it is on the 19th of October, and price does what? It trades lower into the inefficiency, and then it starts to consolidate. As it is consolidating like that, the opening of the next day, which is on the Monday, it starts to print a fair value gap. It is moving higher. So this is telling you that, hey man, I want to go up. And the reason why I trade step index, it is because it tends to give me clear signs of where it wants to go. And I mean it, it's very clear. This displacement going higher, that's high on the Monday. It is close to this high, it bumps it. This high as well, it is close to all of these highs. So what is the market doing here? It is tipping its hand. It's saying this is where the buy side liquidity pool is, and then it drops down. Okay, when it drops down like this, it goes into the consolidation. It hits the highs of those consolidation. If we drop down into an hourly time frame, we can clearly see where price was resisting in this consolidation. Inside of this price leg here, we have a fair value gap inside of this price leg on the 1 hour time frame. It's not visible on the 4 hour time frame. Okay, so let's drop down into an hourly, and I'm just going to show you the fair value gap which was available when price was resisting. Okay, here is the fair value gap high, and here is the fair value gap low. Do you see the fair value gap right there? So we resisted here and here, okay, multiple times within that fair value gap, and we got above the fair value gap itself. So if you treat this as a resistance broken and turned into a support, you would have a good idea of where price wants to go, because it just told you, hey man, this is the high on Monday, and this is the previous high, which is higher than these ones. So it goes lower into a discount, the 1 hour inversion fair value gap. Resistance turned into a support. And then what does it do afterwards? It supports on the new week fair value gap. It's a new week fair value gap, good people. All right. So here is the new week fair value gap. It is the first inefficiency after the Sunday's price action. Okay, remember that Sunday opens a new trading week. So remember that we are in a trending market condition. Price is moving away. I'm just giving you guys a backstory of how I usually trade the contrarian trade setup. Okay. So price had a resistance. It used it when price was consolidating. But now we are in a trending environment. We want to go into the opposing side. We print a fair value gap here. It's huge. We don't fill the fair value gap hole. We don't fill in the fair value gap. Okay? It goes higher. It comes back. We have this inversion fair value gap, and we have this inefficiency. We have two fair value gaps agreeing with one another. The price action wants to go higher. Okay? It doesn't have to even come into this fair value gap. So we make this fair value gap a breakaway gap. Okay? We don't want to see price action coming inside of that fair value gap. The inversion fair value gap will do. Coupling the inversion fair value gap with the new fair value gap, which is much closer to it. Okay, you can clearly see how the 4-hour time frame inefficiency is huge. It is huge, good people. So let's go back into the 4-hour time frame. All right, this is the new week inefficiency. All right, if we have a huge imbalance, what we do with that imbalance, we tend to grade it. Okay, price grading. So let me delete that. All right, as price had supported on the hourly inefficiency, the inversion fair value gap. Right, what do we do with this inefficiency as we are going up? What do we do with it? We use it as a support with people. We springboard higher. Okay, now we have this fair value gap. That fair value gap, we take it and we extend it. This is the hourly fair value gap. It is occurring in the London session. Price comes back down into it only to the 25% of the fair value gap, not the 50%. It only comes back down into the 25%. That is good. If an inefficiency is not traded back to the 50%. If we are in a bullish market, we'd rather see the inefficiency of the 4-hour time frame being respected on the upper side of the fair value gap, not the lower side. If price action had to come all the way down to give us a support, that would not be ideal. But if it comes just above the 50%, meaning it is at the upper quadrants, since we are talking about grades, we just graded the 4-hour fair value gap. So if it goes above the 50%, which is the upper half and the lower quadrant down here, okay? So the upper half, we support on that. That is ideal, all right? Supporting on the hourly fair value gap, this would be a good trading opportunity, okay? So from the Sunday's opening on the 19th here, you are anticipating that price action is going to go in the opposing side, all right? It's going to go up. It's going to be bullish. So each day through Sunday to Thursday, you are anticipating a market condition that is one-sided, meaning that from Sunday to Thursday, you can take good opportunities going in that direction, right? So this is one example of utilizing the 4-hour time frame fair value gap order flow. We are using order flow here to determine that if this is a good trading opportunity. And I just showed you, if it stays above the 50%, then it's a good trading opportunity. So that's one example of it. We can clearly find many trading opportunities going into the upside. So the 19th was a Sunday, the Monday was 20, Tuesday 21, Wednesday 22, and then the Thursday the 23rd. So the 23rd on a Thursday will print this high, or that high there. It is the weekend high, good people. Weekend starts on Friday, we know, Friday, Saturday, Sunday, right? But in Step Index, it prints the high on a Thursday, okay? So what do we label this? This, good people, it is the Thursday weekend highs. This is a buy side liquidity pool, and you can clearly see on the daily time frame on the left that this high of Thursday, it is close to this particular high. Okay, so we are back at the inefficiency, meaning that we have retraced all the way down into the 4-hour time frame fair value gap, new week fair value gap, good people. The first inefficiency that begins a new trading week. That is the inefficiency that we are talking about. I thought that we are talking about order blocks. Where are the order blocks? Well, my guy, since we are in a trending environment, we stopped consolidating. We are in a trending environment. From the 20th, we expect price action to be spooling anyways. It's going to print these inefficiencies. And I teach that the very first fair value gap on the 4-hour time frame, when we begin a new trading week, that specific fair value gap, yes, that's the fair value gap that I'm talking about. The new week trading fair value gap. So where are we trading? We are trading at the 75% of that fair value gap. Now, is that a good thing that we are trading so low? Well, if we are in a market that is going to retrace, it's obviously going to retrace back to the 4-hour time frame inefficiency, right? But how far can it retrace? It has retraced all the way down into 75%. The 75%, what do we find there? We find these 3 down candlesticks. What is that? That's your order block. Your order block is nested with the 75% quadrant level. That is a winner trading setup. Okay, it is a winning trading setup here. So at the 75%, you're anticipating that the market will go up and attack all of these relative equal highs at the Thursday weekend highs. That's where the liquidity pool is. That is what we are attacking, good people. Okay, so we are continuing the movement from the previous week. Okay, we had a little bit of a retracement on a Friday and Saturday. Let me zoom in a little bit so that you can see what I'm talking about. We had the Thursday's weekend highs. Okay, Thursday weekend highs, that's our buy side liquidity pool, the highest high during this particular movement, right? Friday, Saturday, they tend to be a retracement. So we are returning back to the most probable setup ever. Okay, this setup is going to be beautiful, attacking the buy side liquidity pools. And how it is going to do it, it is pretty significant. It's going to be moving with speed. It's going to be quick, fast. All right. That's what tends to happen during this particular time. Around the 20th, it tends to spool, good people. So this is what the price action tends to do around the 20th. So me coming back into the price action, let's say if I missed all of the price action going into the upside on that particular week, I would need to wait for the weekend price action to retrace, and after it retraces, the very first week Sunday, which is today, the 26th, I am anticipating a long opportunity. This is why I'm producing this video. Okay. We can also anchor our trade setup into the daily time frame. Here I'm just showing you a 4-hour time frame inefficiency. But if we look at the order block, we have 1 on the daily time frame here, 2 and 3, price action going lower. So that order block, we can trace it. Let's get rid of the 4-hour one. Okay. We are trading at the 75% of the order block. This is the one here, the 75% of that bullish order block. We've hit the hourly and 4-hour time frame inefficiencies. Those are our medium key levels. But this one, it is our most watched key point in price action. The 75%, 8,129.6. That is a key level from the daily time frame. We don't want to see price action going below the 50% or even attempting to get to the 50%. That is the mean threshold, the 50% of this bullish order block. Okay, so if it were to tag along with the 75% and go up, then that would be a good trading setup. And that will be the end of this video. Hope you guys found insight on this video. I hope to see your appreciation and support through the like, thumbs up. So with that, I'll leave you to it to backtest this information. Good luck.